Appreciate everybody coming today. This is Todd Blickenstaff. I'm the president and program chair of the AAII Portland, Oregon Metro um, chapter, which includes all of Oregon and Southwest Washington members, as well as, and of course, this call. We welcome anyone from around the country to join us as well. And I'm here with my vice president and co-chair of this the income and cash flow meetings that we run for AI National here from Portland, and that's Eugene Tryfin. And our skilled webmaster John Wong is here as well. And then we're going to just a couple of remarks here about upcoming meetings. We do these meetings once a month. And by the way, and we are part of the AAII, which is a Chicago-based organization. It's an independent nonprofit corporation formed for the purpose of assisting individuals in becoming effective managers of their own assets through programs of education, information, and research. So we're not here to give specific investment advice today. It's more informational, educational. So please keep that in mind. And of course, do additional research or consult with your investment advisor before making investment decisions regarding anything you might hear on this call. And we also have, and our focus of this meeting every month is to focus on those investments that provide income and cash flow. And we do these meetings once a month, normally on the third Thursday of each month. And we will be doing that as well for February. And that meeting is going to be coming up. We'll send out additional information on the topic for that, but that will be Thursday, February 14th at this normal time of 4 p.m. Pacific Coast time. And then our March meeting is going to be one day earlier on a Wednesday, March 15th. And we're going to finalize that time. We're going to be doing that in partnership with another chapter that wants to partner us for that day as well. So now wanted to introduce we start out our meetings at the little info that update that I provided with economic and market updates from Gilbert Ho. And Gilbert's got a PowerPoint presentation that he's going to run through, as he does every month at these meetings, to provide us with current updates on and news of note in the regarding both the economy and the financial markets. And Gilbert's a member of the Silicon Valley AAI chapter, in addition to working with us. And skilled in the financial markets, even though he's an high-tech engineer by background. And Gilbert, I'm just going to go ahead and turn the microphone over to you, and go ahead and launch your presentation.
All right, let me grab the screen, and I'll put it on share.
Oh. And while he's doing that, I wanted to mention to everyone, if you have any questions regarding Gilbert's presentation or Matthew's presentation, which is going to be on closed-end funds part 2. We did part 1 last month. Please enter your questions in the Q&A section, and then I'll be monitoring those questions, and we may stop periodically throughout the presentation to pass those questions along to Gilbert and Matt respectively during their separate presentations to make sure, because we just find it's easier to keep track of those questions if you enter them in the Q&A, and you won't forget to enter them if you do that while you're thinking about it, and we'll be able to read them to stay on top of that as the presentation flows. So again, Gilbert, go ahead and start her up.
You can see my slides?
I can, yes.
Okay, cool. All right, let's go. So legal disclaimer. I think the bottom line is we're not giving advice, and even some of the data show patterns. Just not really, there's no way anybody can dictate the future. So we started out by looking at interest rate because that drives the economy. And so there are 4 charts here. On the top left is the usual yield inversion pattern with 10-year Treasury versus 3 months, or 10-year Treasury versus 2-year Treasury. And we can see that the 10-year versus the short-term 3 months Treasury is still quite inverted. Past experience seems to say that if you look at the 2019 thingy, it's really when it's disinverted or uninverted that trouble starts. But then again, this time may be different. On the top right is the federal fund rate and 2-year Treasury. I think recently the theory is the 2-year Treasury is actually the market consideration for what the Fed funds rate should be. So when you see that the purple line, which is the 2-year Treasury, is way below the red line, which is the Fed fund rates, there's a pressure for Federal Reserve to lower the rate. And it's obvious in March 2023, when we have the banking crisis, that the market is saying telling the Fed should lower the rate. Of course, the Federal Reserve didn't listen to that. Hopefully this time they will. And so the bottom line is when you see the green line is below 0, negative, on top right, you know there's a pressure to lower rate. Now, lower left is the actual yield curve, and there are 3 lines here. You can see the green was January 2022 when everything's normal, and the top red is what we are right now, and it's inverted because the short-term rate is now higher than the long-term rate, which is not normal. So,
right
now on the lower right,
curve, versus the normal positively sloping yield curve, which is the green line. Okay.
Yes, gotcha. Exactly. So the green line is the normal pattern. Now on the lower right is the showing the Federal Reserve balance sheet versus M2, because in addition to raising rate in 2022, Federal Reserve is also trying to shrink its balance sheet starting in 2022, and so far, they have reduced about 1.2 trillion off their balance sheet. And I calculate at the rate they are doing, it takes about 4 years to go back to eliminate the 4+ trillion that they injected during the COVID. So they're on schedule doing that. And hopefully they'll continue to do that and doesn't have much impact to the system, because they were concerned that when they do the quantitative tightening, they will cause the treasury market to have price gyrations. But so far so good, knock on wood. Also, we can see that the green line is the M2 trend line, and we have a huge jump in M2, and a lot of people attribute that to the inflation pressure. And now it's stabilizing.
To the money supply, right? Okay.
Yeah, the M2 is the money supply. Exactly. Yes. So so the idea here is slowly the orange line or the purple line, I mean the orange or the yellow line of the M2 money supply should go back to the trend line. And so that's where we are right now. Now, I'm showing things related to GDP because people look at the GDP as the growth indicator. The very old classical indicator is this PMI, ISM Purchasing Managers Index on the upper left. the old saying was whenever it was under 50 or negative, it is showing slow down, and when it's above 50 line, it's supposed to be good, and we are below for a long time. So people are saying manufacturing section may be in recession, but service economy is still going, and U.S. economy is mostly service now. On the upper right shows a weekly economic index, and basically trying to project what the GDP would look like. And the same thing is on the lower right, which is Atlantic Fed's GDP nowcast of what they think Q4 GDP will be. And you can see that it zigs and zags, but now it's above 2%. I think it's about 2.5% now. On the lower left, it shows the year-over-year GDP growth. So there seems to be two ways of looking at this. On the lower right, the GDP estimate is on the quarterly basis. But if you look at most of the stuff, we look at year over year. So on the left, lower left, I show the year-over-year GDP growth. You can see that, it seems to be hovering around 5%. Right now, on Q3, we're above that. We're above 5%. So you usually hear people say we're 2% GDP, and that's quarterly. But if you look at year over year, we're 5%. So the media sometimes confuse you. That's what I think. Next one is okay. So if you listen to the Federal Reserve Chairman Powell talk about inflation, he seems to attribute the inflation to two things, to two sides, right? The demand side and supply side. And on the demand side, that's the consumers, and that's what this is trying to show is the retails. And on the supply side, we talk about supply chain, and supply side has two parts, which is the goods supply and the service supply. And on the goods supply, we'll show a PPI later, producer price index, and we'll look at the commodity. And on the service supply side, we'll look at the employment, labor. So on the demand side for the consumer, the retail sale, which is the purple line, it shows a very obvious spike for that inflation period in 2021, 2022. And it's coming down quite nicely. We're well within the usual range. So you can say, at least on the retail part, things are back to normal. I also overlapped it with the University of Michigan consumer sentiment indicators. And the pattern in the past two recessions, the 2000 and 2008, it's obvious. You're at a level, you drop, then the retail sale follows. And if you look at it 2020 until now, you see the drop and you see the recovery, and the economy is good. So we might have a recession that we didn't realize. So the jury's out, so we don't know. We will know only later. On the lower left, that was the I got this chart from Apartment List, and they do surveys all over the country, and it shows that rent are not going anywhere. It's cyclical, but it's not. We're on the downside. On the lower right, we show here is the business sales and inventory. Inventory to sales ratio. That's the I guess the orange line or the yellow line, and that seems to show spike in recession in the past, and we have a spike in 2020, but now we're at a level that we were before, and so I assume that is a good sign.
Hey, Gilbert, a question for you. With respect to the rents, apartment rents leveling out and declining a bit, do you think that's a function of rental rates just getting ahead of themselves, or is it more capacity coming online in terms of available apartment rentals for, I know here in the Pacific Northwest and Portland area specifically, we've had a lot of apartment units come online here in the last year or so, or do you think it's a combination of both or any other factors?
From the what I have in from apartment list, it seems to be they attributed a big portion of this downward pressure on supply. So in the last, once COVID hit, even before COVID, even 2019, I think at least, for example, in the Silicon Valley, building apartment rents are really, really expensive, and it's so when time is good, you have to remember these projects, especially the big complex, takes years, right? So once it's like a train, once they started, they can't stop. And in 2019, everybody want to start it. So even COVID hit, they still have to go. And also, at least before 2022, interest rate was low. So it's much easier to get funding and build it. So now they build it, and it's all come online. So it seems like a perfect storm to push the rent going down. That's one part of it. The other part is people also look at this and say, well, if the demand is weak, that means the economy is not good. So maybe, they said like 60% of the population is a homeowner and 40% is renting. And I think maybe the renting part, the population are having problem paying rent. So I think it's both sides. I think there's supply helping, and there's also demand pressure, lower pressure to lower the rent. That's just my 2 cents.
Well, yeah, and I see one of our attendees today commented they just got a rent increase, and of course, this is a national average, and it's going to vary a lot from
right.
From market to market. And somebody also asked, where's the data is from? Could you just reiterate? This is the apartment list.
Yeah, if you look at the let me see if I can do it. If you look at this part, I have this highlighter here. It says data available at this website. You guys see that, right? The red dot. So if there's no question, I'll move on to the next slide. So, one of the big concern that everybody has is the labor market. And the Fed look at this as if there's, there were, what was that before the great, there was a big exit, right? So when we look at this chart, the main thing is the number, the inserts I have here is the number of unemployed person per job opening. We are like more jobs per person looking for jobs. So that is the best thing you can have. Remember, Federal Reserve has 2 mandates: inflation and employment. So on the employment department here, it's really good. The purple line shows that we have more job openings than before pandemic, and also the hiring rate and the total separations. That means layoff, quits, the whole 9 yards is back to normal, I would say. And also there was the big exit from the job market. Now that shows up in the quits, the yellow line, orange line down below here, and I think that's negative. Oh no, that's less than 2.5%, which is back to normal. So job market is back to normal, and there are plenty of jobs. Top left here is the initial claim, the initial unemployment claim, and this morning's report showed is way. I don't know if this is a new low, or if not new low, at least in the last 12 months. So less people are unemployed, and or newly unemployed, I should say. And on the right-hand side, this is we have more jobs, we're hiring more people, and people are going back to work, and that's what this green line is showing, the labor participation rate. I think that Chairman Powell mentioned about this participation rate many times. And so again, employment is its situation is good. However, lower left is the temporary servers number. And in the past, when it goes below, when the year-over-year rate of change is below 0, is negative, it doesn't bode well. So there are signs that traditionally or classical signs that tells you there may be the economy may be weakening, but then again, it's not consistent. So we don't know what exactly going to happen. Finally, I look at the US dollar because when we are in the upper range, I personally think that helps fighting inflation. So I look at this, and the next one, we look at commodity, right? A strong dollar buys you a lot of commodities. And if you look at the, if you use this to predict what the January inflation will be, then there's not a whole lot of pressure here. I see corn going down. I see copper going down. I think the gasoline is not is staying helpfully. So that's what this chart is trying to show, is that we don't see the huge ramp up of prices in these charts. Finally, the inflation numbers. So the upper left is the purple line shows you the producer price index, and we also have the import price index and export price index. All of them are annually in the negative growth area. So that means prices coming down, which helps inflation. And the upper right just shows you the 4 different numbers in terms of inflation. But just remember the red one, the red line, which is what the Federal Reserve actually looking at. So when they're talking about 2%, they're actually talking about the red line. And if you look at the red line, is still about 1.2, 1.3% above 2%. You know what I'm trying to say is at 3 point something, it still need to come down somehow. And the lower chart just shows you a longer range comparison of different countries, the inflation rate. I think China has some most volatile inflation numbers. I didn't show 1995, and I think in 1995 they went to 20%. And then you're in the Eurozone in 2022 they were the leaders. Now they're coming down lower than us, so that's a good sign. That means globally the central banks are lowering rate because inflation is coming down.
Gilbert, I know there's concerns about deflation in
Yes.
China, and China has even had some deflation during the past few months. Do you have any comments on that?
Yes. If you I'm not trying to pretend I'm a China expert, but just from the numbers here, whenever the inflation is negative, that's deflation, right? So you can see the red line for China right now, they're negative, and they had been negative in 2021, and they have been negative in 2008 and the 1998. So I think a lot of times we forgot. Ever since Japan topped out in 1990, they were experiencing deflation, and so for the last 20 years, all the central banks around the world their concern were deflation. There were no inflation pressure. Their worry is we go into deflation. That's why they keep the rate so low. And now, because the COVID imbalance, we get an injection inflation, and all that reminded people was 1970s. But then again, the world is quite different. So we're in a territory we've never been before. So it's going to be very interesting. But just another comment on China deflation is it is a godsend for us because if they were not in deflation, then our inflation pressure will be higher. So it's a good thing for us.
We're one of their larger trading partners, right? And we could be importing inflation rather than goods and services at lower rates since they are experiencing deflation. Okay.
Right. They will sell you cheap,
Gotcha.
and that's all it matters, right? So,
right.
Yeah. And right now, I think this week there is some kind of conference in Davos, Switzerland, and if you watch some of the interviews, it's very interesting. So, of course, the buzzword was AI, but I see CNBC has a lot of interviews of a lot of smart people, so it's an interesting event. Anyways, so this chart is trying to say there are 4 indicators of possible financial. Well, I should say this is 4 different indicators of a financial condition. And so every one of them worked in 2008. Every one of them picked up in 2020. And every one of them is negative right now. So I think if anybody is hoping Fed will lower rate to save the system, it ain't happening right now. There's no financial crisis right now. The leading economic indicators are sort of old. It was this one December, and the January one is coming next week. But this thing has been negative for so long. If there's no recession, I don't know what they're going to do. They used to be very, very reliable. This is a chart. This shows you the sentiment of professional investors. So I quote Warren Buffett here says, like, be fearful when others are greedy, and greedy when others be fearful. So this indicator shows the professional investors whether they are greedy or fearful. And you can see in 2022 they were fearful, and in 2020 they were very greedy. Now, as of this morning, which is a survey from yesterday, it's pretty close to the threshold area. So, I think it's much better than when they are very greedy right now. I think they're neutral. Cryptocurrency. I know we're income group. We don't talk about speculation, but the news here is this week or last week is the SEC finally approved the Bitcoin ETF. This was the price and yesterday, and I think today is more close to 40K than 42K. So all I'm saying here is it's interesting and event. I mean, you can look at the Bitcoin as like gold. If you're a gold bug, you probably can understand why people are crazy about crypto. Anyway, all right. So I have this personal theory that COVID actually kicked off a great retirement boom, and I'm trying to find the data to prove that. And here are 2 charts. One is the Social Security expenses, I believe, and you can see because of inflation and maybe because more people are drawing Social Security now, the year-over-year spending, we're at a higher level. We are at about 12.5% year-over-year. And the lower chart is a little bit scary. That is, if you look at the 401k, 403k, that's what they call defined contribution pension plans. The cash flow, right? The contributions versus the withdrawal. And before 2020, generally contributions above withdrawal. But this is the annual data. So, but for the last 2 years, since 2020, we are getting more withdrawals than contributions. And so, you can assume this is going to be the long-term trend because we're less people contributing and more people taking it out. But for whatever it's worth, just to show that they're, baby boomers are exiting and this is showing up here. So I saw this thing about money market assets. They said like there are 6 trillion of it. So this is the fuel for the stock market. So I look at the money market and versus the stock market. The only conclusion I had was the money market deposits usually peak during a recession, and so of course major market bottom is in recession. So that's the only conclusion I can draw. And if I look at what they have latest, we're at some kind of peak, but we're not in recession. But it's stock market at the bottom. So jury's out. Then I look at the money market versus 3-month treasury bill interest rate. The conclusion here then is much clearer. It is the higher interest rate, the 3-month treasury bill, attracts people to put money in the money market. So the treasury rate leads the money market deposits. And then once the interest rate goes down, after a while, the money market exits. And lower interest rate inflates the stock price, and the money that leaves the money market goes into stock market. So I guess the headline is correct at the end, but the logic is working more like in the bottom. Finally, I think everybody saying like the stock market usually goes with the liquidity. When there's more liquidity, the market goes up. When there's less liquidity, money goes down. So a gentleman in Houston, AAI Houston, presented this indicator. And the formula is I show it. I showed it here on the top right. So it seems to work sometimes, but it seems the opposite of the other. So I just showed it here for the fun of it. I'll look at this, and if I can get more conclusion, I will present it next time. Finally, this is election year, and everybody has like seasonality plays a big role. So I showed this last time, and I just updated it a little bit just to put it into one chart, just to say that the average looks tame, but the actual is scary. But anyway, I'm going to track this. So the blue line is what we are so far this year. That was up to yesterday. I think it's an update today, so I don't know if we went back to 0 or close to it. And if you hear people say the first half of the year is going to be flat, and that's because of this, right? And because you can see the trend usually happens after first half. Finally, I'll put my head out and say this is the expectation for U.S. economy for me. So the employment is fluctuating between 3.5 and 4.5, and which means they're not too bad. And the core PCE inflation is 2.5 and 3.5. Right now we're 3.16. So I assume they were lower rate, but they will still keep it relatively high. And therefore, the yield curve never uninvert, and people would keep on telling you there will be recessions. And commercial real estate continues to be a problem because the rate is not low enough. And people are not going back to work. They work from home. Economy stays no lending, meaning we're not slowing down. And the stock market climbs the wall of worries because people keep on telling you recession's coming. And that's all I have. Thanks.
Thank you, Gilbert. And I think the consensus of market strategists is a higher percentage of them now think that we can avoid a recession versus a year ago. There was, I think, a much higher percentage that were looking for full recession. So it's kind of interesting to see
Right,
that.
right. So if 2023 is an example, what I put down here will be the opposite of what actually happens.
Okay.
So
So you're saying it might be a contrary indicator.
yeah, exactly.
Well, it happens to all of us at some point in time trying to prognosticate on the market. Thank you very much, Gilbert. Does anybody have any additional questions? I don't think I see anything in the Q&A section right now, but if anybody has a question they want to voice, we'll take that, and then we're going to move on to the next portion of our presentation. So. I'm going to guess not at this point. So, but thank you very much, Gilbert. Appreciate your insights as always. And now we're going to move on to the next part of the presentation, which actually is part 2 of the presentation from last month. And that's going to be presented by Matt Crouse, and going to talk about exchange traded funds, excuse me, closed-end funds, part 2, trading examples and income closed-end funds, which more of the closed-end fund universe is focused on. Excuse me. Muffle a sneeze there. Yeah, in the bond market than equities. And so just to remind everyone before turning the microphone over to Matt, is that he's an adjunct professor at Westminster College in Salt Lake City, and was a recipient of the 2016-2017 Gore School of Business adjunct faculty. Research interests include closed-end funds, exchange-traded funds, and other fixed income products targeted to retail investors. Matt did work for 15 years as an analyst and portfolio manager at Western investment firm, well-known firm, hedge fund focused on closed-end fund arbitrage and activism, and has also done research and risk management for 2 energy trading firms. So a very deep and skilled a skill set that Matt has. Also, he's got a PhD in electrical engineering from Rice University and an MBA in finance. He's a CFA and a member of the CFA Society of Salt Lake City, as well as AAII, longtime AI members. So looking forward to the second part of your presentation, Matt, and going to turn the microphone over to you and have you take it from here. Thank you.
All right, thank you. Okay, so same disclaimer. This is for educational purposes. It's not investment advice. I will do a brief recap. If you're interested in any of these concepts, look at the prior talk, which is on the AAI website. So closed-end funds, CEFs. We'll be talking about exchange-traded CEFs, and they trade on a stock exchange between investors. They have 2 dimensions that are different from open-end mutual funds. They have premiums and discounts, and leverage, which is investing on borrowed money. Premiums, discounts. A closed-end fund's net asset value is the same definition as an open-end mutual fund, but closed-end funds also trade at a market price. And if the market price is greater than the net asset value, the closed-end fund trades at a premium. If the market price is less than the net asset value, the closed-end fund trades at a discount. And most closed-end funds trade at a discount, which leads to potential buying opportunities. A closed-end fund's premium discount reflects a variety of factors, particularly supply and demand. And factors influencing demand include historical fund performance. So, funds that have better historical performance have more demand and tend to trade at lower discounts or even premiums. Management fees, the higher the fees of the fund, generally the bigger the discount. Investor sentiment for the asset class, as asset classes go out of favor, funds in that asset class tend to trade at discounts. And general market conditions, like in bear or pessimistic markets, you get larger discounts. And for analyzing closed-end funds, I recommend the website cfconnect.com. You can go to CEF Connect and get data on any individual fund by typing in the ticker. But CEF Connect also has a fund screener, which I'm going to go over in a minute. For the best data, when you're looking at a closed-end fund, not only go to CEF Connect, and again, I talked about it last lecture if you want to see it, but also go to the fund manager's website for further information on holdings, performance, and fees. I always view the fund manager as like straight from the horse's mouth, and that'll be the most up-to-date and accurate data. Here's an example page from cfconnect.com. This is BlackRock Health Sciences Term Trust BMEZ, and it'll give you an overview page where it gives you the market price, the NAV, and the premium discount, as well as the dividend rate. Now, in finding attractive closed-end funds, there are two factors. They're like discount-related factors and then fundamental factors. And in terms of discount-related factors, I mean, the most obvious one is a large discount. Like the larger the discount you get, the better the deal. However, some funds trade at large discounts because they have bad characteristics, like they're really small or have real high fees. So that alone is not enough to buy a fund. I like to see a negative Z-score. And a negative Z-score, it's a statistical indicator, but it really indicates whether a fund is trading cheaper or more expensive than normal. And a negative Z-score means it's trading cheaper than normal. A limited term, like a term, some funds will pay you back net asset value after a fixed term. And that means that the discount should go to zero over time. And so that's another positive, a limited term. And then shareholder activism. If an activist investor like Saba owns the fund, they may take some action to get the company to reduce the discount. Other factors to look for in choosing a closed-end fund: low expense ratio. This is harder to find in closed-end funds than in like ETFs or open-end mutual funds, because a lot of closed-end funds have high fees, and leveraged ones include the leverage expenses in those fees. But it is still a good fundamental factor. Good long-term performance versus benchmark is another predictor of mutual fund returns, not only closed-end mutual funds, but open-end mutual funds. Strong earnings and undistributed investment income. I'm going to talk about those today. And of course, a high yield. Investors love funds with high dividends. Okay, so that was a brief overview or review of last time. And now I'm going to cover running the closed-end fund screener. I'll show you how I run that and talk about bond CEFs, investing in those, and do a recent case study investment example. So here's the website CEF Connect, and to get you can enter a ticker here, and that will give you the information on individual closed-end fund, but you can also do the fund screener. And I'll show you how I run the fund screener. And I'm just going to start from a new search, which probably is what you would be doing. So I start new search. It's going to clear all my prior screen choices, and I'm okay with that. And first, we're going to talk strategies. And for this example, I'm just going to look at equity funds. There are other categories like municipal bond, taxable bond, as well as hybrid, which is a mix of equity and debt. So first you choose your category, but we'll just do equity, and I just did select all to select all the funds, all equity funds, just to see what we get. And then you click criteria for the information that you want to find. Actually, I'm going to click a setting here real quick first. In settings, I need to log in here. To get the maximum use out of the screen, you do need to create a screener account. And so It's free, but you do need to set that up. So that reset everything. So I'll select my equity funds. I'm going to go to settings. And one thing that is not a default, but which I think should be, is it has some hidden columns. And one hidden column is that I think is useful to see, at least if you're beginning, is the fund name, because you'll see all these tickers and you won't know what they are. And so at least you should have the fund name. As you get to know these better, you can hide that column because it does take up space. So I'm just going to save the display setting to include fund name. Then I'm going to go to criteria. And in fund basics, I like to include, actually, I'm not going to include anything yet from fund basics, although some things like whether they use leverage, the market cap, those can be useful to see, or whether they have a term. Those are all like potentially useful items. But to keep the screen small, I'm just going to include the really key items, which includes the distribution rate. So like that's the dividend rate. Some people like distribution frequency, like whether you get paid monthly or quarterly, but I'm not going to include that. And then of course, discount premium. And then I like to see a couple Z-scores. Z-score 3 months says, is the fund cheap in the 3-month time period? And Z-score 1 year shows, is the fund cheap in a 1-year time period? I also like to go to performance and look at longer term returns on NAV. Like studies have shown, when you look at mutual fund performance, only like really longer term time periods are predictive of future performance. So I usually don't go to like 1 year. Like 1 year is often just like how the asset class did that year. So then I select all the criteria that I want. And of course you can play with this. And then I go down here and I click view funds. And it gives you the ticker and the name, the distribution discount, basically in the order that I clicked things. And if you click on a column, it sorts by that column. And so you can see here that I've sorted by discount premium to look for like the most attractive funds with the biggest discounts. But other things where that might be interesting, for example, are the Z-scores. So for example, this STU, this SARH Total Return Fund, it has some negative Z-scores as well. So it's not only cheap on an absolute basis, but it's cheap relative to its historical average. And then here we have the returns on NAV. So with this, I'll go back and say there's some interesting things that you might want to add. So like market capitalization or term. Baseline expense ratio would be really useful, but that comes out blank. So I just avoid it. So like here I'm adding these 3 as like some fun basics that we could also add. And now we can click view funds. And now to see these extra items, you scroll over to the right. And for example, you might want to choose funds. These market capitalizations are less than 100 million. Those are going to be low volume, hard to get in and out. And they're probably like inefficient with fairly high fees. So you might say, oh, I want to avoid closed-end funds with a market capitalization below 100 million. Some other things to consider too are term. Like generally, it's good to have a term. That means at some point the discount should go away. It may be like 8 or 10 years from now, but it's still a positive. And then leverage, which I'm going to talk about next, like whether the fund uses borrowed money or not. So that's an example of running the fund screener. And if you like, you can save the search. I would call this equity fund search for later use. So that's an example of running the screener. And so here I give like instructions kind of corresponding to what I did. And here I show like the results that I just got, just in case that's useful for your review. I'm here and I talked about the other 3 things. You might add market capitalization, term, and leverage. One disclaimer about running the screener, that's just a first step. Don't buy closed-end funds from the screener without researching them further. You have to do your own due diligence. I would check the holdings, expenses, trading volume, performance, news, etc. One disclaimer also is just check for special events. I don't see any special events right now. But for example, Cuba had a rights offering where it traded at a humongous discount, like 40 or 50%. Because of the rights offering hadn't occurred yet and the rights offering was dilutive. So you don't want to buy in, like look and see a large discount, buy into a fund like that. And then, oh, note that, oh, there's a rights offering that's going to dilute me and I'm going to lose money. So that is the screener. Next, I want to talk about leverage and bond closed-end funds. And unlike open-end mutual funds, closed-end funds can use leverage or borrowed money to invest. And this can make bond closed-end funds attractive. Leveraged bond closed-end funds usually offer higher yields to their investors than you get in an open-end mutual fund. And that's because funds borrow at low rates and invest at higher rates. Also, funds borrow at a cheaper rate than typically you can borrow at. So they have efficient institutional pricing. So it's better for the fund to borrow and buy these things than you to buy them on margin. Currently, I would say it's not a great time for bond leverage because the Fed funds rate is greater than long-term rates, and so that's less attractive now. A higher Fed funds rate means high borrowing expenses and lower dividends for these funds. Also, leverage adds risk. Now, Fed rates could change the outlook, and let's just look at the yield curve, which Gilbert already talked about. Like the typical yield curve is upward sloping because as you're lending for a longer period, you're taking on more risk, and investors demand higher rates. So this is the usual. If you want a plot of the current yield curve, you can click that link. And it's good for closed-end funds, the typical yield curve, because they borrow at the low short-term rate and then they lend at the higher long-term rate. And typically, most of these closed-end funds, not only do they get the higher long-term rate, but they lend to either companies or municipalities that have credit risk. And so they get paid an even higher rate than this due to a credit spread for bankruptcy risk. And so with that, their investing rate is typically, a good amount higher than their borrowing rate. And for that reason, leveraged closed-end mutual funds historically have paid, significantly higher dividends than open-end mutual funds. But as Gilbert talked about, right now we're in an inverted period, which is not particularly attractive for leveraged bond funds because these funds are borrowing at a high short-term rate and then they're lending at a lower long-term rate. Now, now there may be a credit spread on this longer-term rate. They may be like lending to junkier companies. So like, the rate may be up in this range, higher than where they're borrowing, but it's still a negative. And it may not be offset by the expense ratio that you're paying the fund company to borrow. It may not be offset by the expense ratio you're paying, which is additional cost to you, because the fund company tends to not only charge you expenses on the assets of the fund, but also on the leverage that they use. And so for that reason, in this environment, leveraged closed-end fund earnings may not be better than open-end bond mutual funds. I'm sure you all know this already, but I'll just quickly review. I want to talk about bond price risk. Bond prices go down when interest rates go up, and that's because new bonds issued in the market pay a higher coupon than the old bonds in your portfolio. And so because your old bonds are not attractive, the prices of bonds in your portfolio go down. Similarly, bond prices go up when interest rates go down, and that's because instead of your bonds being old, now they're vintage. They're paying like higher rates than what's going in the market. And so they become more valuable and the prices of your bonds go up. And this bond price risk is called duration. And because leveraged closed-end funds own more bonds, they're investing borrowed money into extra bonds, their price risk is amplified. And so, for example, this is an old page for Brandywine Global, BWG, and you can see it had investment exposure of 264 million, whereas the actual common assets of the firm was 154 million. And so basically they have about $1.72 invested in bonds for every dollar of assets. So they're about 1.72 times as risky as a regular bond fund. They'd have 1.72 times the duration risk of a leveraged bond fund. And that can cut both ways. If you think rates are going down, then buying into leveraged closed-end fund could benefit from that. But if rates go up, then you're going to see a greater loss. Here's a subtle point on bond risk that I don't think most investors realize, is bond prices are sensitive only to the market rate of their same maturity. And bond closed-end funds typically own long-term bonds that, historically have paid higher rates. One exception to this is the category of loan closed-end funds and limited duration closed-end funds, which you can select for in the screener if you're interested in. But they're a subclass of bond funds. Most closed-end fund funds own long-term bonds, and therefore, because they own long-term or long maturity bonds, they're typically sensitive to the 20 to 30-year rates on the yield curve. And one risk that I want to point out is that the NAVs on these funds could decline even as the Federal Reserve cuts short-term rates. So don't just buy into a closed-end bond fund saying, oh, I love that leverage because I know the Federal Reserve's cutting rates and that means bond prices will go up. That's not necessarily the case. And you can look at this by looking at the yield curve. When the Fed cuts rates, that takes the short-term rates down. But now when that happens, long-term rates could go down, but they could also go up. There's no, it's really based on the supply and demand for long-term US Treasuries. And so it's not automatic when these rates go down that these rates will go down too. They could go down, but it's not a guarantee. And so one thing to be careful about is there is, even if the Fed cuts rates, there is a potential for these longer term rates to go up. Some of the reasons are the quantitative tightening continuing, as well as kind of investors get tired of lending to our US government that keeps, having massive deficits and borrowing lots of money. I don't know which way it's going to go. I just wanted to point out that's a potential risk. And one other element to that is long-term rates have already decreased about 1%. They were about the 10-year was about 5%-ish like a few months ago, and it's decreased to a little over 4% right now. So my overall outlook currently on the bond closed-end fund market is it's not an attractive environment to own leveraged bonds unless you expect several Fed rate cuts or long-term rates to decline further. And I just don't know where long-term rates are going to go. Now, Fed rate cuts will improve closed-end fund dividends. So if you do see a lot of Fed rate cuts, then that becomes a time where you might want to look at buying some leveraged closed-end bond funds. However, the cuts take time to filter through into earnings. One or two cuts won't make a huge difference. Also, cuts can take a few months to reflect into higher earnings and income. So after the Fed acts, it takes a few months for you to see those cuts reflected in the fund's earning reports. Speaking of which, closed-end earning reports are great for predicting future closed-end fund dividends, in my opinion, and an undervalued tool that I want to talk about next. So all closed-end funds publish their earnings in what's called undistributed net investment income, or UNI. And it kind of is like it's kind of like you're getting a cheat sheet for the test. You have an idea of like whether the fund is going to be raising or cutting its dividends. And it's a simple concept. If the fund is earning more than its dividend, then you have a possible future dividend increase. If the fund is earning less than its dividend, then you have a possible future dividend decrease. Now, bond funds also publish UNI, undistributed net investment income, which is income that has already been banked to pay for future dividends. And so that's money that's been accumulated. And the thing to know about UNI is if you have a fund that's under earning its dividend currently, but has a large positive bank of UNI, they can pay income out of their UNI and delay cutting the dividend. So what's most at risk is when you see a closed-end fund with earnings less than the dividend and a negative UNI. That's most at risk for dividend cuts. That said, there's no guarantee that you'll get a dividend cut. Some funds will pay you a return of capital, or some funds just delay a long time before cutting the dividends. And so having earnings below the dividend and negative UNI is no guarantee for a dividend cut, but it's an indicator that a dividend cut could be likely. Here's an example. I mean, as you probably know from like investing in income stocks, you normally don't want to own a stock in front of a dividend cut. It's the same thing for a closed-end fund. This chart here I have for PIMCO California Municipal Income Fund, PCQ. Now it was trading at a ridiculously high premium because they were paying like really high tax-free dividend that investors loved. Then they had a major dividend cut, and after that, the fund started trading at a discount. I mean, it was a huge cut. It was like it was one of those where PIMCO like delayed cutting it too long, and then they had like an extreme dividend cut. So not all funds would be this bad, but it's just an example. You don't want to be a bag holder owning a fund in large. I mean, in general, you don't want to own a fund in front of a large dividend cut. And so since you want to avoid that, that's why I feel that closed-end fund earnings and UNI reports are useful to go through. And large closed-end fund managers like Nuveen, BlackRock, and PIMCO publish their monthly earnings and UNI reports for all their funds. And you can find these on the fund manager website. Now, some of the smaller fund managers only publish their data in annual and semi-annual reports, and those come like every 6 months. So with those, you have a larger delay. And to get those, you could check the fund manager website for the annual or semi-annual reports, or go to the SEC filing NCSR. And the NCSR is like a 10Q or 10K for stocks. It's basically that, you know, the report filed with SEC. I want to do a case study in PDI earnings. I just noticed it recently. A lot of Seeking Alpha articles are recommending it as a great buy right now. They do have several good reasons. PIMCO is a skilled bond manager. I think they may be the best, bond manager that's easily available to investors. The fund has an eye-popping 14% yield. PDI's leverage enhances enhances returns if bonds continue to rally. So the bonds had a great rally in Q4, not so much year to date, but if rates continue to drop, long-term rates continue to drop, that leverage is going to juice their returns. Also, they have a large allocation to mortgage bonds that seem undervalued. Research I'm seeing says, mortgage bonds seem undervalued versus say like corporate or other bonds because they're trading at larger spreads than normal. One other thing they pointed out is PDI has a history of paying special dividends. So you weren't only getting this high yield, but you might get an extra bonus at the end of the year. What bugged me with this analysis is that these authors missed a concerning earnings and UNI report with the fund PDI trading near a 10% premium, which kind of elevates when you have a fund that might cut its dividend. if it's at a premium, that elevates the risk that it could go down. So here's a PIMCO earnings report I pulled from their website. You can like Google like a PIMCO ticker and earnings and uni report, and or go on their just on the PIMCO fund website, and you should be able to find a report like this. This is data as of November. And I'm going to highlight PIMCO, the one mentioned by Seeking Alpha, although you'll notice like the coverage, dividend coverage in all their funds is less than 100. So all their closed-end funds are currently subject to dividend cut risk. And notice the uni on all these is negative. And especially PIMCO, the PDI has an especially large negative uni.
Matt, can I ask a question here?
Sure.
Yeah, and actually one of our attendees at the meeting asked about that. Well, and asked why are so many of the PIMCO funds either, narrow discounts or even at premiums, given the risks here? Is the market missing something?
Yeah, I would say most investors don't know about this. Like these Seeking Alpha articles that have these guys have thousands of followers, like they make me, I have maybe a couple hundred. I mean, they have like news services, and a lot of them aren't tracking this. There are good Seeking Alpha people that do track this, but many don't. And so they're saying, oh, look at historically, this has paid large dividends and even special dividends. And they just look at past history without looking at the facts of like what, the portfolio is earning right now. So it's really an inefficient market, in my opinion. I could be wrong. I mean, it could be these funds deserve to trade at premiums because PIMCO's so smart. But as for myself, it's too risky for me to own, and I couldn't sleep well at night if I recommended these funds to others.
Well, I was wondering if investors are paying up for the brand name here, because PIMCO is a well-known brand name, and Bill Gross used to be there, but that was years ago. So
they're a well-known brand name, and they are good. They are a good manager. And if you look at a 14% dividend with a good manager, and you just do that superficial analysis, you'd say, well, what's not to like? Like, I'm getting this awesome dividend from a great manager. But so yeah, I think those are probably the reasons.
and they missed the free lunch concept, I guess.
Yeah. Great question. Now that was the Union earnings report. I'm just going to show you from the like semi-annual report. You'd have to look at this. Like if you're like maybe one of these smaller funds, they may not publish like a monthly earnings and Union report. And you have to go then the semi-annual report, which is called the NCSR, or just it's called semi-annual or annual report on the website. And you'd scroll through it and you'd find like a section like this. And it tells you, what they earned in the net investment income for the year, what their net realized or unrealized gain or loss is. Also, it tells you the dividend they paid from a net investment income, as well as dividend from realized capital gains. And it tells like basically, what's the total change in net asset value for the year from all those factors. I will point out that some funds that are lacking on interest income can, if they have high realized gains, they can pay those gains out instead of interest income. And that's what like stock funds will do. Stock funds, will, hopefully have earned gains on their portfolio. And when they realize those gains, they pay that out as dividends. However, and PIMCO, I think, has done that in the past. Like they paid out some dividends from realized gains that kind of supplements the income they get from bonds. But I also looked on the annual report and saw that, as of June 30, 2023, that's the latest report I could find. They had a lot of like capital, unrealized losses and other things. So I don't think bonds have rallied enough to where PIMCO is going to be paying out from, like this fund's going to be paying out from capital gains. But this is an example of like using the other source, the NCSR. It does, and it's nice, it gives you some additional information like realized capital gains, and you can go through and look at their portfolio and other things. But one disadvantage is these are so dated, you know, like the last one is like 7 months old. One thing you can notice is that like if you look at the NAV on this thing, it's gone like from 32 to, you know, 20 as of June 30th. I think it's around 17 now. And the dividends, I think the core dividend has remained unchanged. Like they did, you know, they aren't paying the special dividends, but it is showing how the assets generating income have gone down, but they haven't cut the dividend. So that's another potential indication that at some point they're going to need to bite the bullet and cut the dividend. I can't guarantee that it's going to happen. I can't guarantee you there's going to be a dividend cut. I'm not saying like short sell this, or if you're buying it, I'm not saying that's necessarily a mistake, but I personally wouldn't own it for myself. There's just too much risk there. And on the topic of dividends, one thing that several closed-end funds have is called a managed dividend. And when there's a managed dividend policy, they don't necessarily have to earn the income they pay out. The fund will pay out a fixed dollar amount or percent of NAV every year, whether they earn it or not. And my comment on this is your dividend payout is safe until it isn't. And so as long as they keep that policy, you're in good shape. But sometimes they will adjust the policy. So, you know, they might say, oh, we're going to pay 10% of NAV every year, and that's our dividend policy. But if they see like their assets are going down too much, they may change that policy and decide, oh, we're only going to pay 5% of the dividend, 5% of NAV every year in dividend. And my general comment on when that happens is cuts in those like managed dividend policies generally happen when the asset class in the closed-end fund significantly underperforms. I'll give an example of a stock, BlackRock Science and Technology Term Trust. They had paid a 0.1613 fixed dividend per month as, you know, tech was rallying and they were getting, you know, the portfolio is doing really well. And they cut that dividend down to 6% of NAV per month, like basically 10 cents in September 2023. Actually, tech had already started rebounding, so they kind of maybe delayed that a little too late. But, you know, 2022 wasn't a great year for tech, and BlackRock looked at their assets and decided, oh, we don't want to pay out as much in dividends, so we're going to change our managed dividend policy. That's just an example. So that's my coverage of uni income and managed dividends. And so next I want to talk about a case study example. Actually in this very same fund, this BlackRock Science and Technology Term Trust, BSTZ. And so here is when they announced the cut in distribution. And you know, it's already trading at a fairly good discount. And they announced a cut in managed distribution. And due to that cut in dividend, as well as kind of basically October was kind of ugly. I think the combination of those led the discount to widen out to 25. And that kind of piqued my interest. And so like seeing the discount widen to over 22% discount was interesting to me because it's such a high discount is uncommon for a closed-end fund from a well-known manager, BlackRock, particularly as the closed-end fund has a term ending in 2031. So like, you know, in you know, what would that be? 7.5 years, you're going to get NAV back. You're going to make the discount. So yeah, so the discount should disappear by the end of the term. Now they could maybe delay it a year, or there are other little technicalities, but essentially around that time period, it's no longer going to trade at a discount. And for that reason, funds with terms like this tend not to go to huge discounts because you know you're not stuck with that discount forever. And so for that reason, that closed-end funds seem worthy of investigation for a buy. And I'll just highlight some of the pluses and minuses in my buy decision. I'm going to start with the minuses. The fund is a technology fund. It has a high expense ratio of 1.33%. I mean, you can look at some alternative like QQQ, which is, probably less than 0.1%. Excuse me. And so you're paying a high expense ratio. That's a negative. Also, as a complicated strategy, I'm not a big fan of complicated strategies in any kind of funds, closed-end funds or others. I generally view them as a way for the fund manager to underperform. In this strategy, they would sell covered calls. And covered call funds tend to underperform the market. I mean, they do generate higher income, but the problem is in volatile markets, the option premium that you get is nice, but it limits your upside when things recover. Excuse me. So, I mean, covered call funds tend to underperform equity funds because in a down market they go down almost as much, and in the up market they don't recover as much. The extra income doesn't offset the loss of upside. If you kind of have a flat market, then they can outperform. The other thing is private equity. I'm not a huge fan. Private securities are hard to value and sell. And so when I see them in the closed-end fund, I worry, are they valuing it right? Would they be able to sell it at the price that they're recording it on their books? Like they have some leeway in setting what the value of that is. Now, BlackRock's a well-respected firm, so I don't expect any underhanded valuations, but it's still like an issue. Like if they just own Apple, their portfolio is being fairly valued. If they're owning private securities, you have to have some faith that they're valuing them correctly. Another negative is they had a poor NAV track record. They significantly underperformed the tech sector. I attributed a good chunk of that underperformance to them owning this 25% in private equity and like investing in private equity kind of in a bubble when rates were really low. And as rates have gone up, these private equity valuations have gone down quite a bit. And so I feel like that underperformance hopefully will not continue in the future, or at least some of it, that it's already been like baked into the stock. I also say that like the covered call could have caused it to underperform during a volatile environment, but I'm not leaving out that, stock picking and a high expense ratio, like bad stock picking and a high expense ratio could have contributed to their underperformance. And so that's a negative. One thing that I'll mention as a negative, it's really just a negative compared to its other funds. There's other BlackRock term trusts like ECAT and BMEZ that actually have Saba as a large activist holder, where they're making filings and making shareholder proposals. And so this fund does not have that. So I did not see Saba as a large holder in this. One day you could open up and they might say like ECAT is going to do a large tender offer or going to merge into an open-end fund and the discount could go away. Now you might just ask, well, if these have activism, why don't you buy them? And their discounts are narrower. And so that reflects the potential activism in them. And so for that reason, there's like no free lunch. Like you might say, oh, I want to buy these funds that could have activism, but you're getting them at a much lower discount. But the fact that this one lacks activism, means I want to see like a good large discount that I could potentially, make a high return off of. So let's, with all those negatives, you might wonder like, why are you even considering this? And I think the pluses outweigh the negatives for a trade. And again, I'm looking for a trade. I'm not I'm not looking to hold this until the end of the term. And one thing that I saw is a 22% discount with less than an 8-year term left is not something I see very often, if ever. I don't recall it very often. You know, maybe when there's like a big huge, you know, financial crisis or COVID panic, but it doesn't happen very often. At the time the Z-score was highly negative, and you can kind of guess what the Z-score is. Like if the discount is say like 25 here, and if you're looking at past 3 months, you know, it's say going to be like, you know, an 18 average. That's going to be a highly negative Z-score, you know, maybe -5 or -6. So that's like a highly negative Z-score, indicating that the stock, you know, is, and you can really just get it from the chart. The stock is a significantly larger discount than where it has been in recent history and also in the longer history. So that looks like an aberration that you could potentially make money off of. Also, it's in the tech sector with some AI exposure. NVIDIA is the top holding. I don't particularly like, and I'm under allocated. Like I have an income portfolio. I'm under allocated to tech. And so I'm okay having that in my portfolio. I'm not saying, you know, I'm not really good at predicting how tech's doing, but I don't mind having that. It also, the private investment includes some AI and other stuff that's there areas that are hot and that I feel like could have an IPO where they do really well. And so I'm not a fan of private investment, but if my company's going to have private investment, I want it to be like an AI. I don't want it to be in like glamping or some other stuff some of the other BlackRock funds own. Also, BlackRock was buying back shares, which is a positive. If they buy back shares at a discount, they're actually earning for the fund kind of the difference between the discount and the market price. And so that's really good for shareholders. That buying pressure also tends to narrow the discount over time, although they often don't buy enough volume to make a huge difference. And also closed-end funds tend to narrow seasonally going into Q1. That was from my last talk. And I expected many investors were selling to take tax losses. And if you have sellers that are, you know, selling for non-economic reasons, artificially depressing the value of something, that's when I tend to want to buy. And even though they cut their dividend, they were paying a 6% NAV dividend payout, which is around a 7.5% payout based on the market price, which is still pretty good. And so despite all the negatives I talked about on the other slide, I expected to make at least 5% on discount narrowing. You know, I thought it was, you know, likely that, you know, in this 22 to 25 range, it could go back to, you know, the 17, you know, like the 15 to 20 range in a short amount of time, hopefully. By the way, I went to the fund website and looked at their literature on private investments. It's always great to look at, you know, if you go to a fund, look at all the literature that you can on the fund. And here, like, for example, some good signs for their private companies. You like it when the current value is greater than their initial investment. That means, you know, it's trending up, and, you know, hopefully if they do an IPO, there's going to be more capital appreciation. And you like to see, you know, this area, it's cloud-based software that provides a unified platform for data analytics and artificial intelligence. Here's an example of something that's, oh, actually that one's up. Here's an example of one that's down. Although it is in a good area, semiconductor technology that integrates artificial intelligence, but the fact it's a little bit negative. Oh, no, actually all these are up. No, this one is down. Sorry, I misread it. So this one's up and it's in AI. And so this is another good one. This one's down. They put in 34 million and it's down to 20 million. It's a software company providing open source products and solutions. Like that would be a private investment I'm not so excited about. Its value has gone down and you might expect that it'll continue to trend down. It might rebound, but I'd rather to see trending up than trending down. So anyway, here's kind of where I bought and sold, the the closed-end fund BSTZ, which is represented with this blue. Blue is like the market price return. And so I was buying in October, like in this area, I'd say between like 22 to 24% discount. That looks plenty good to me. And I was buying, and basically I bought my fill. So I'm going to tell you, I didn't get the exact bottom. Like the exact bottom was a 25% discount and, lower price than I bought it. And to be honest, my first initial purchases, like in this area, were down a lot. I was down like 6 or 7%. So with these things, you have to expect some volatility. Like I thought, eventually it was going to work out, but I was looking pretty stupid on my initial purchases. That's why I like to scale in and not buy everything. But I did, it looks really attractive to me. So I bought like a full position here. And then the market, bottom around October. I think I said this in the last talk, but and that was more to do the macro stuff. But there is a joke between me and like one of my colleagues, former colleagues, the closed-end fund market tends to bottom around Halloween, Thanksgiving, or Christmas. And this year it was Halloween. It bottomed around Halloween. But anyway, when after the Fed said, oh, they're not, they're getting more dovish and maybe some cuts next year, you had a huge rally in tech and closed-end funds. And it got back to a 17 or 18% discount where, I sold some there. I thought, well, that's kind of a target that I was trying to make. And I made it, within less than a month. Plus I got all this NAV appreciation. It was time to take some money off the table. And then from there, I was like, I still do own some, I was like, oh, I think, discounts could narrow more going into the Q1 of next year. 17, 18 is still pretty good for a term trust. So I'm going to hold some. And that's turned out to be a mistake. If you look at it on those, from here to here, the fund basically was pretty flat in terms of return. And that's because the discount has widened back out to like 20, I think maybe like 21% as of the close yesterday. And you can also see that like if I had just bought QQQ, which I made as a comparable, I mean, this one owns smaller stuff. I mean, it does own NVIDIA, but also owns some of these private companies. But still, I think it's good just to compare to like a general, tech sector type comparison. You can see like, oh, if I just owned QQQ, that would have rallied a lot more. So I did great in this initial phase, and then I've been underperforming in this recent phase. And now that it's around a 21% discount, I'm not inclined to sell it. But I would have done better had I just sold it all here and invested in QQQ. So it just goes to show, even when you have all the factors in your favor and things work out, it doesn't necessarily mean that it's going to like work out for the long term. And you, sometimes carefully managing these positions can be important, and not just like buying and forgetting. So in a recap, I showed you how to run the closed-end fund screener. You can play with it yourself and tweak stuff and save things. My 2 cents, and I'm not great at forecasting macro, but I'd say the environment is not great for leveraged bond closed-end funds currently, because short-term rates are greater than long-term rates, and most of these funds are under earning the dividends. I do think, pay attention to Fed rate cuts. As we start getting multiple Fed rate cuts, it might be a sector or an area that you want to invest in. I will say, like, if you do really think that long-term rates are going to decline from here, you could buy bond closed-end funds to make a leverage bet, because you are getting leverage on that money. Like for example, that BWG had 1.72 times as much assets as or invested as assets. So like if rates went down, they would rally 1.72 times as much. But that's not a bet I'm making. I also showed you the earnings and uni report, which I think is a good tool to predict dividend cuts and raises and help you better time your closed-end fund purchases and sales. And I preferred a case study of a recent trade that I did to show you some of the things that I look at. And that's the end.
Um, Matt, I've got an additional question here. I had to go to a cell phone because I lost my power here on the screen. So, and I can't see the screen right now, but just as other questions come in, is there a minimum discount that you will use as a sell signal? And do you ever hold a fund, a closed-end fund that reaches a premium price to its NAV?
I generally, yeah, that's a great question. And it sort of depends on the fund, but I generally tend to sell funds when they're at premiums, as they go into a premium, or I also look at their range. And so I do make it somewhat fund specific. So, for example, if I've seen like a fund never gets to a premium, I click here and I go click a long-term chart. Like here's the PDI fund. And so like I see on this fund, which it's the fund that I disparaged, but you know, if I were to buy it at a discount, I might hold out for some kind of premium because you've seen that it's traded at premiums in the past. Whereas like, you know, a fund like, I'll plot this BWG. Like this fund has stayed in the, like over 5 years, the 16% down to a 6% range. And so if I saw this fund, you know, in the 6 to 8% range, I would probably sell it because historically that's about the best it's ever done. And so I also let the historical range of the fund help me determine where I buy and sell.
Gotcha. Okay. Have you looked at there's several fund of fund products out there now? I guess that Columos just rolled one out. Do you have any opinions of these fund of funds products out there in for CEFs?
That's a good question. One thing I don't like is the double layering of fees, but I think when you have an attractive environment and say that fund to fund is at a good discount and what it owns is a good discount, I think that can be a good time to buy. And so I think these can be like some good tactical trading opportunities. I don't necessarily want to hold them that long because you're getting like fees upon fees. But yeah, I think they can be good tactical ones, and one that yeah, besides Calamos, like there's one SPE, Special Opportunities Fund. It's kind of a small, it's kind of a or SPE, and I'm not recommending it as a buy, but it's another one of these closed-end funds that invest in closed-end funds and other income products. And I mean, if you're looking at discount,
and I'm wondering with the high fee level still for investors who want to have closed-end exposure in a diversified portfolio, if a fund of fund can be a good substitute for them just because somebody else is picking the underlying funds, and it might be worth it for them. I guess if the income, particularly if the income payout is sufficiently high to offset the double expense ratio.
yeah, I would agree with that. And I haven't looked at them as so much as buy and hold. They may be buy and hold opportunities, but I view them as as potential, like when discounts are wide, you're getting potential double benefit because you're buying the fund at a wide discount and what the fund owns is at a wide discount. So you're getting a double plus. However, when they get narrow, then I would say you have a potential double negative, because if like discounts widen from that narrow level, if discounts widen from that narrow level, you're getting it both in the fund you own and what they own. And so you have double risk. And so I would just I would tend to keep a shorter leash on those. If that makes any sense, in that, like, if they got like to a well valued level, I would tend to sell them.
Well, and maybe if you're able to get a discount of like 20% from NAV or something, that could help offset the combined expense ratio.
Yeah, and I don't worry about the combined expense ratio. You know, it's like over the short term, like I said, it was a negative, but if I'm folding a fund for a few months, it's not the end of the world. And it's just something I keep in mind, owning it. Like if it gets to an expensive level, I tend to sell it just because of the double risk and the higher expense ratio.
Well, I think that makes sense. I have to say, because I can't see the screen right now because I have to do cell phone connection. John, maybe you can tell me, are there any other questions in the Q&A section that we
Yeah.
haven't answered?
Yes, there's a couple of other questions, and I think it's best if Matt can open the Q&A
Okay.
panel.
All right.
Okay.
All right. I'll go in there.
Yeah,
Just
you
a
can read
sec.
them directly, Matt. Yeah.
Okay, just a sec. Q&A. What do you think of CF fixed income funds offering senior loans? I like senior loan funds.
Mhm.
And because those funds, they lend like shorter term, and so you don't have the risk of, like, say, long-term rates going up. So senior loan funds, I think, are good
Yeah,
now.
because they're floating rate, right?
Yeah, they're floating rate. They float with short-term rates. I would just be careful if we go into recession or we get a lot of Fed rate cuts. So like they're good to own now, but if we get a lot of Fed rate cuts or we go into recession, because they tend to lend to riskier companies. And so I'd say they're good to own now, but just be careful if we go into that environment. Because if we go into recession, there'll be defaults in those portfolios. And also if there are rate cuts, the income on their portfolios go down because they're actually borrowing based on the shorter term rates. And so they could have dividend cuts. But one good thing is, just like I said, if rates go down, there'll be some lag. Well, there'll be lag for this too. So their dividends won't go down immediately. There'll be some lags. So you'll be able to see it in the earnings reports.
Right, they could catch up with you though with a potential widening of the discount. And as you pointed out, I mean, and we talked about this on one of our earlier calls where you weren't the speaker on that one, but we talked about the fact that duration risk was the big risk last year because that's where people took the hit in the NAV. Spreads really stayed relatively narrow in the bond world, but that may not be the case this year.
Yeah,
So,
yeah, spreads could definitely widen.
Attention to that, yeah.
Yeah, spreads could definitely widen, which would hurt you on the NAVs of the riskier loans. Yep.
Okay.
I have a couple more
Any
questions.
other questions that you see there? Go ahead.
Yeah. When modeling a specific CEF, do you use Monte Carlo to understand range of risk and what variables to use as input variables? I think Monte Carlo is cool, but I don't use it. It just takes time to like set it up. So I just think more kind of common sense, like what could rates do? What's the economy doing? Kind of follow things like Gilbert talked about, like what's going on in the economy and how that might impact my fund. You can look at things like duration, like if you're worried, oh, what if rates go up 1% and the durations on my fund is 7, or spreads go up 1%? Well, that means the NAV would go down 7%. So you can look at things like that in addition to Monte Carlo, some of the portfolio measures that the fund manager will provide you, but I don't use Monte Carlo per se. Closed-end funds are supposed to be primarily for income, but it seems like you're using them as trading vehicles. Is that true? And for me, that is true. Like, now if we get to a yield curve environment where you have a positive sloping yield curve, then I think they can be valid, income investments. But for me, in this current environment, it's just too risky for my blood. Like, I'm not going to chase a dividend where I think that I could have seek significant capital losses. I'm going to wait for a better environment. So yeah, right now in the current environment, I see them more as trading vehicles. If we get more to a normalized environment, they do pay higher dividends than open-end funds and have had higher returns. But I would want to see a return to that environment for me to hold them for longer time periods. Excellent questions.
Well, and I know that you may have seen the same presentation I saw where CAF Connect was talking about the fact that the spreads are relatively wide right now, and they're favorable based on historical parameters. But I wonder how much of that is the impact of rising interest rates here recently. I would think that could have had some impact on spread widening particularly for the bond funds
Yeah,
in the
and
CEF world.
the discounts are attractive. They're pretty wide for many bond funds. But they're not, they're sort of, and there's a reason for that is they're not doing their job. Like they're not earning, at least they may be paying higher dividends, but they're not earning higher dividends than the open-end funds because
Mhm.
they're not really earning more on their leverage right now. So they sort of deserve to be at bigger discounts until like we
Mhm.
see like some Fed rate cuts.
Right, right. Yeah, I would think they would respond favorably to that. Although you think they might be discounting that with the Fed saying they may have, at least they've done with raising rates in this cycle. But interesting. Okay. Any other questions in the Q&A that
No,
to cover? Okay. All right. So well, it's I think we're about 5:45 right now. Matt, I want to thank you for another outstanding presentation. Thank you very much for doing that. And then again, we'll have part 2 of this presentation out on the website at some point we get through compliance, right, John? And
Right.
then I want to thank John Wong as webmaster here, also Eugene Tryfin and Gilbert's presentation too, and thank you everyone for attending here. If you're calling from the Pacific Northwest, you know it's been choppy here, which is why I lost my connection. And but appreciate everybody's time, and I hope everyone stays safe and warm and is able to keep the power on. And again, we will be have a meeting in February. We'll announce the topic on that in the near future. So keep an eye. That's February 14th will be our next meeting, and then the March meeting will actually be on a Wednesday of March 15th. So more information to come on those soon, and appreciate everybody's call here, just taking the time to do it, and just remind you that we're an independent AI, is an independent nonprofit corporation, and this purpose of education. So please don't interpret any of the information on the presentations as investment advice. It needs to be tailored to your individual situation. So please, all of you, keep that in mind. And thank you very much for calling in today. And we hope to see you all soon.
Thank you.
okay, bye.
Thank you.